All right, cool. Just double checking my feed on everything. I think we are officially live. So welcome. I hope you all are having a great Friday afternoon. I am actually just doing a live replay of the market outlook that I did earlier, that I did about midway through the month last month. Actually has some weird tech stuff happen, and I wasn't able to record any of the presentation. And not only was I not able to record it, none of the audio came through. So I presented for an entire hour, only to later find out that not only did the feed transmission not go through, but also the audio didn't go through, right? And the and I forgot to hit the record button on my Zoom. So I had promised a couple of people that I was going to send them the recording, and don't have the recording to send them. So the only thing that I can do is re-record it. So welcome. Today we are going to talk about basically the multifamily market outlook for 2022. And we're essentially going to go over a number of marketing or market outlook reports that essentially are going to give us a lot of detail on what's happening in the marketplace. So I'm going to do a screen share and we'll get started from there. So let's do the screen share. I'll start here. All right, perfect. All right, so welcome. So, all right, so we'll start off with the Yardi Matrix report. This is the National Multifamily Report from December of 2021. We'll go over this report, and then we'll go over a couple of others. Now, Yardi publishes information on a monthly, quarterly basis, and they also they cover a lot of different asset classes. So with the multifamily asset class, we'll just cover some of the summary information, and we'll touch on a couple of things because these reports sometimes they can be extremely long. But just to give you a highlight of how 2021 went down in the multifamily market, you have U.S. multifamily rents rose modestly in December, increasing by $2 to a record 1,594 and dollars, and that's per month, closing the book on an extraordinary year in which asking rents rose by 13.5% year over year. Rent growth in 2021 was more than double any previous year recorded by Matrix. I just want to double check before I get too far. All right, looks like we're still good. And part of that being you had a lot of issues, a lot of slowdown in 2020. So there's some catch up there, but also you have just a dramatic increase in demand. So moving on from there, we expect rent growth to decelerate in 2022. It should be a strong year nonetheless by historical standards, closer to the 5% annual increases recorded in the middle of the past decade. Not sure if we're going to see rent deceleration throughout the rest of the year. I think that's going to depend on a number of factors. Then also they have a snippet in here about single family rentals. If you're in a multifamily space, you know that there's been a big push for single family rentals where companies are buying basically portfolios of single family homes and they're renting them out. Rental growth there was slightly more than multifamily rent. That growth was at 13.8% last year, as opposed to the 13.5% year over year in the multifamily space. So looking at this chart, I want to zoom in on this a little bit so you can see it. You can see the dramatic increase since February, right? December 2020 and February 2021 up through December of 2021, there was a dramatic increase in the average national rent asking price, as much as almost a $200 increase over the span of 1 year. So as you can see, significant increase. And part of that also being the fact that there has been a lot of logistical issues with supply and demand when it comes to new construction and being able to complete construction and being able to complete construction, as well as just the cost of materials going up and making it more costly for developers to build new housing stock. So you have a lot of different pressures that are coming down on the multifamily space. So looking down, we'll scroll down, looking at year over year rent growth. This is New York rebounds amid national growth. So there are actually, of the top 30 markets, 26 of them saw double digit gains, with 6 of them seeing gains of 20% or more when it comes to year over year rent growth. The only 4 markets that did not see rent growth, I believe, were New York. Let me just check. It was New York, San Francisco. Let's see. Where's that data at? I'll come back to that. But there were 4 markets that did not see double digit growth. Out of the top 30, 26 of the top 30 metros saw double digit gains of 20% or more, with the top leading markets being Phoenix at 25.3%, Tampa at 24.6%, Miami at 23.5%, Orlando at 22.7%, Las Vegas at 22.2%, and Austin at 20.9%. And when you look at a lot of the top markets for rent growth and also population growth, a lot of those markets are going to be in the state of Florida, including Tampa, Miami, Orlando. Those markets are seeing a lot of growth. So I won't cover too much on a short-term rent or STRs, but let's see. There is some data in that about that in this report. Let's see some employment and supply trends and the forecast of rent growth. The pandemic has brought about a huge change in migration patterns that are still developing. If you look at our 2021 market outlook, we talked a lot about the migration patterns. Demand for less expensive secondary markets with warm weather has led to rapid rent growth, and only 4 markets nationwide remain below pre-pandemic rent levels. Let me see if I could find those 4 markets. I know New York was one of them. I think 2 of them were out in California. Here it is. All right. So meanwhile, only 4 metros, largely coastal centers, San Jose, San Francisco, New York, as well as Midland, Texas, are the only 4 metros of the top 30 metros that have not seen year over year rent growth. Let's see. And still remain below pre-pandemic rent growth levels. All right, so let's see. The pandemic continues to affect commerce and travel, and the future of migration remains unknown, but clearly the shift to the South and the West will endure, will continue. We'll move on down. Let's look at some of the employment and supply trends and the forecast and rent growth. Again, I mentioned some of the year over year changes, the top year over year changes with many, as you can see in this chart, many of the markets seeing double digit gains. Even some of the lower markets seeing 6.7, 4.9%, 8.3%. So the year over year rent growth has been pretty strong across the country. Now looking at year over year job growth, we have some strong job growth, with the highest being Las Vegas at 11.5%. That most likely being because Las Vegas opened up. If you remember, at the start of the pandemic, they had to shut down. A lot of people lost jobs. So it's good to see that a lot of those jobs in Vegas have come back. You also have places like Orange County at 8.3%, Orlando at 7%, Phoenix 6.5%. So of course, when we're looking at multifamily, we're looking at hot markets. We also want to see some consistent level of job growth or strong signs of job growth. Moving on down to occupancy and asset classes. Let's see. This is a chart that breaks down lifestyle versus renter by necessity. When you talk about lifestyle renters, they're basically renters who have the ability to purchase, yet they decide that they actually want to rent instead of purchase for one reason or another. And then you have your renter by necessity. Your renter by necessity, essentially, they have to rent. They have no other option. They can't afford to purchase for one reason or another. So when you look at occupancy, all asset classes by month, the strongest growth was in your lifestyle occupancies, with that number growing from 94.5% up to close to 96%, total occupancy being just at 96%, with a large portion of that being in lifestyle renters. Then we've got year over year rent growth in other markets, showing that we have some markets that are seeing 33.5% year over year rent growth, with lifestyle renters growing 36%, renter by necessity rent prices growing by 29.1%. So you just have an abundance of rent growth compared to 2021. So that just shows you, or excuse me, 2020. So that just shows you the market. The market performed really well in 2020. So it's also just showing that the market continued that strong growth in 2021, and also has come into this new year with very strong momentum. So let's see, market rent growth by asset class, just showing a different breakdown by market. You've got Atlanta, you got Boston, you got Denver, you got Dallas, Houston, Inland Empire. Looking at these various charts, one thing that you notice is that they all had a major dip in 2020, some form of a dip in 2020, but then they also had a very quick rebound in 2021. And that's really positive, because the dip was primarily because of people were restricted from moving, right? They were restricted from moving. There were foreclosure and rent moratoriums and things like that. So the entire industry was on pause in one way or another, but the industry was able to rebound very quickly in terms of just recovering from any potential losses that may have been incurred during 2020 in the onset of the pandemic. So just going down again, market by market: Tampa, Seattle, Washington, D.C., San Francisco. And again, all of this information is from the Matrix National Multifamily Report from December of 2021. Again, I don't want to take up too much time. We got a number of reports to get through. And let's see, let's check out Freddie Mac's next. Actually, on the first one, I did not do a review of Freddie Mac's report. So Freddie Mac is one of the two government agencies that are responsible for funding a lot of the multifamily loans, right? So let me just double check, make sure we're good across the board. All right, cool. So pull this up. All right, so Freddie Mac is responsible for lending a lot of money in the multifamily space. So it's no surprise that they have their own research center. So what I wanted to do here is just double check, or not double check, but just look over basically a summary of what their multifamily market outlook was. Here we have throughout 2021, strong economic conditions and changing migration patterns have pushed multifamily market fundamentals to record-breaking levels. The economic and multifamily recovery is expected to continue through 2022, although COVID-19 is still with us, which could cause fresh waves of economic uncertainty that will likely persist throughout this year. Now, I'll say something briefly about COVID. Like, yes, we are still in COVID, definitely, but one of the good things is that at least with the most recent variant, it hasn't been that extreme in terms of causing a lot of death, not nearly as bad as the first wave, right? So a lot of people are catching COVID. They're recovering from COVID, and I even know people who have caught COVID multiple times, right? So unless you're in a position where you have heightened health concerns, of which even with the Omicron variant, it might not be as severe. The virus is not as deadly as it was. So I say that to say that over time, over the course of this year, it may get easier for us to get back to, some sense of normality as the COVID strain becomes more like a common cold, as opposed to, what we saw in 2020 when they were stacking bodies in empty trailer trucks in New York. That was just crazy on a whole nother level. But anyway, so during 2021, the economy bounced back meaningfully, with improvements seen in the unemployment rate, weekly unemployment claims, and gross domestic product. Inflation, however, has emerged as a concern going forward. Definitely the cost of everything has gone up. Demand for multifamily housing during the second and third quarters of 2021 was at the highest levels RealPage has ever reported. RealPage is a data source. Reese reports rent growth is expected to have increased by 10% for the year and vacancy rates to decline to 4.8%. Again, we have mentioned that in the prior report. A lot of markets have seen double-digit rent increases, and the vacancy or occupancy rate as high as 96%, 95%, 96% or above. So when you're projecting, you're doing your projections, and you're trying to go over your vacancy rate, realistically, you can use a 5% vacancy rate and be right in line with the market expectations. So multifamily investment activity again spiked in Q3 2021 to a quarterly record of almost 79 billion in property sales. Through the first 3 quarters of 2021, investment value totaled 179 billion, more than any other full year on record except for 2019. And 2019 was a record-setting year for multifamily investment sales. So again, the math and the numbers are just confirming that the demand for multifamily space is still at an all-time high. Coming off a record-breaking year in 2021, we expect multifamily markets to continue their growth, albeit at a more moderate pace. Demand is expected to remain strong, and given recent elevated levels of permits and starts, completions should also remain elevated. And for 2022, we forecast gross income growth of 3.6% and the vacancy rate to remain flat at 4.8%. And then just 2 more bullet points. We expect universally positive rent growth in 2022, with each market we cover projected to experience rent gains. The Sun Belt markets are generally expected to outperform the nation, while the smaller markets in the Northeast and Midwest are generally expected to be among the comparatively weaker performers. I guess that's, being relatively speaking, considering that the markets are up all across the board. And then multifamily originations for 2020 came in higher than expected at 360 billion. Considering the robust performance and strength of the apartment market, we expect originations in 2021 to grow to 450 billion and to see further growth to 475 billion to 500 billion in 2022. And by originations, they essentially mean loan originations. So let me just double check, make sure we're still good on our platforms. All right, cool. Looks like we're still good. All right, let me bring it back. Okay, perfect. All right, so let's pull up the next report. Let's pull up Newmark's report. So Newmark's report, this is actually dated from, after the third quarter of 2021. So it's a little more outdated, but I like Newmark and their market reports because they include a lot of good information, a very extensive, well thought out, well executed market reports. So let's cover a few key takeaways. Again, this was through the third quarter of last year. So some of the key takeaways as we were heading into the fourth quarter and finishing up the fourth quarter, a lot of times because there's so much data involved, right? And there's so many data sources that this data has to come from. Oftentimes the data is behind. So the data for Q4 may not really start to come out for another couple of weeks. So it's not uncommon for you to look at data that's a little bit behind in some ways. So let's see, sales volume. They're talking about Q3 21 total 78.7 billion. Another thing, the numbers oftentimes may be a little bit different because these companies are pulling data from different sources, and different data sources ultimately you're going to have different data. Some will be better than others. So the numbers may not always be exact, but they'll always be good enough to help you, make your decisions. And by reading multiple reports, we're able to get a broader perspective on what's actually happening in the marketplace. So rent growth again, effective rent growth grew 5.9%, the largest quarterly increase on record, increased to 3.1% on an annualized basis. Increased demand for apartments is projected to support strong levels of rent growth through the end of 2022. Remember, we were talking about rent growth year over year being at 13.5% nationally. Dry powder. Dry powder is basically the amount of money that investors have that they are sitting on, and that they've allocated towards investing in a particular asset or asset class. How they calculate this number, it's hard to say because to me, it's kind of subjective. How do you know how much money, right, everyone has? But anyway, dry powder rose to another record high, totaling 237 billion. Closed-end funds have earmarked 78 billion specifically for residential investment, with 75.7% of that set aside for opportunistic and value-add strategies. So here, where they're counting their dry powder, is they're looking at closed-end funds, and they're looking at and probably hopping on different calls for these funds to find out specifically what the investment strategies are for those funds. And then they're including that information. So this dry powder number probably is significantly higher for a lot of investor sources that haven't even been included in that count. So let's see, supply and demand. Let's see, in Q3 2021, 268,331 units were absorbed, marking the highest quarterly absorption figure in history. As more workers return to the office and the cost to own single-family homes continues to rise to historic levels, rental housing is anticipated to see strong demand. Another reason why single-family rentals are extremely popular, because people have not been moving, right? During the pandemic, although there's been migration, that migration hasn't been from people who actually own property. People who own property, they've just been staying in place, right? Staying in their homes. So the inventory levels for existing single family homes has been off from traditional levels. So that's caused even more increased demand for single family homes, which has resulted in higher sales prices. So let's see, total returns. Multifamily total returns rose 12.3% through the first 3 quarters of the year and 13.4% on an annualized basis. Markets throughout the Southeast and Southwest are among the strongest performers over the past 12 months, led by Phoenix, Vegas, and Raleigh. We talked about that on the last report. And then debt markets, multifamily mortgage debt outstanding rose to 1.74 trillion, a 1.4% increase quarter over quarter, with 776 billion in multifamily mortgage maturities estimated from 2021 through 2025. Both the multifamily investment sales and financing markets are likely to remain robust over the next several years. And then we just have some additional breakdowns of charts covering the sales volume. And you can see a historical chart from 2001 up to 2021. And you can see that up through the third quarter, we were on pace to break the investment sales record level of 2019. And then looking at the monthly sales volume and how the ebb and flow throughout the last year, how it ebbed and flowed from month to month. And actually the last couple of years, this goes back to 2010. Sales volume by market. I always like looking at this one because it gives you a graphical visual of how active various markets are or have been, right, in the transaction value. Seattle, Portland, LA, San Diego, San Antonio, Houston. As you can see, four markets in Florida have been extremely active. 8.1 billion in South Florida, 4.2 billion in Orlando, 2.6 billion in Jacksonville, and 4.7 billion in Tampa. And then investment allocation to multifamily, essentially how much money is being allocated towards multifamily as compared to overall commercial real estate investment sales volume. 2021 saw as much as 38.6% of overall investment uh, investment volume going to the multifamily space. A breakdown of capital flow analysis. Let's see this one. Investor preferences for assets located in non-major markets continue to grow, totaling 80.4% of investment through the first 3 quarters. Investors had largely targeted suburban multifamily markets prior to the pandemic, given higher total returns and strong population growth. However, this trend continues to accelerate. So suburban markets are still pretty popular. That originated from the urban flight in 2020 when cities started to shut down and you had the urban core basically empty out. People started leaving downtown areas so that they can get more space. And since we were sheltering in place, people wanted to have more space to themselves. They wanted to be further away from people. So that trend has continued. Let's see, total returns, looking at annualized returns. This is boosted. Let's see, boosted by the resurgence of strong appreciation. Multifamily total returns rose to 12.3% through the first 3 quarters. On an annualized basis, multifamily returns total 13.4%. And this is subjective. If they're talking about investment returns from the investment itself, you have a wide range of what those returns look like. If we're talking about the rent growth, that's a little bit different, but I think this is the investment returns, which ranges a wide range, a lot of times even over 20 or 30%, depending on where you are in the deal. Let's see, total returns by market. So let's see, driven by strong appreciation returns, markets throughout the Southeast and Southwest are among the strongest performers, led by Phoenix, Vegas, and Raleigh, as we know. As you can see, they're breaking down all of these different top markets, and they're showing what the investment returns were as compared to the U.S. national average. San Francisco, New York, Chicago, San Jose, Oakland, Los Angeles, Boston, Minneapolis kind of making up the tail end of that, with San Francisco seeing the smallest amount of return growth at 1.7%. Just more breakdown on dry powder and what the funds are targeting. This is good to know if you're looking to raise capital from a fund, having an idea of where they are allocating their funds between opportunistic investment strategies within multifamily, value add, core, debt, distressed, and core plus. And those are just basically different definitions for the asset itself and the condition and financial performance of the asset. Let's see, yield spread, not 4.6%. Let's see, so the yield spread at 4.67%. That's the U.S. multifamily average cap rate at 4.67%, compared to the 10-year treasury yield at 1.52%. And then the yield spread is the vertical line graph showing the yield spread up over 300 basis points, I believe that is. Yep. Cap rates just showing. So the lower the cap rate, the lower the cap rate, the more demand for the particular asset. So you can see back in 2002, cap rates on a national average were on a 12-month average were as high as 8%. In 2021, the lowest was 4.5%. So that's just indicating that the market is extremely, extremely, extremely competitive. And then this is a breakdown of major markets versus non-major markets. And as you can see, in your major markets, the cap rate is at 4.5%. In non-major markets, the cap rate is still pressed at 4.72%. But I will say this, depending on what market you're investing in, there is still a lot of markets where properties are selling for higher cap rates. So I don't want you to think that there is no money to be made. It just depends on where you're investing. Now, this is a breakdown of cap rates by market and essentially showing, again, those top 30 markets, what the cap rates are, but pretty consistent, with the tightest being in San Francisco. San Francisco trading at 2.8% right now. And that was third quarter of 2021, which means that San Francisco is extremely, the demand is extremely strong relative to what's on the market. And then the highest being Baltimore at 4.5%. So as you can see, a low of 2.8%, upwards of 4.5% is still an extremely tight market with still very strong demand. We've got a price per unit. This is showing our price per unit average, national average of $221,081. We've got, let's see, showing our major market average at 319,000, with our low non-major markets trading at an average of 203,000 per unit. Again, the high of 319,000 per unit and a low of 203,000 per unit. But again, those are averages. So depending on what market you're investing in, I've still see units trading, at 40,000, 50,000, 60,000 and up. So there's still a lot of opportunity out there. Top buyers and sellers. This is showing some of the larger transactions. Blackstone was the top buyer. Alliance Residential was the top seller. Blackstone was the second top seller. So Blackstone was buying and selling pretty actively last year. I think in 2020, Morgan Properties was actually one of the top buyers and one of the top sellers, but they seem to have cooled down a bit last year. This is on effective rent growth and essentially just showing the growth of where effective rent growth is. And that's basically the net rent that you're getting. Let's see, the annualized number at 3.1%, 3.1%, and the quarterly percentage as high as 5.9%. But the forecast is showing that there's a downward trend on effective rent growth. So that's just something to keep an eye on as the year progresses, how the expenses, the concessions, essentially the concessions are how those play out versus what the asking rents are. That's going to impact your effective rent growth. And then just showing a breakdown of the markets and where they are in terms of year over year rent growth. All right, new lease out trade outs by market. I won't cover that. Supply and demand. I'm just showing some supply and demand charts. Let's see, year to date, 535,463 units have been absorbed nationally, compared with just 270,770 units delivered during the same period. 268,331 units were rented in the third quarter of 2021, marking the highest quarterly absorption figure in history. So, even if you're in a situation where you have renters who are exiting the market, you have a record number of renters who are entering the market as well. So the supply and demand balance, here's a chart showing the supply and demand, showing that absorption is outpacing new supply pretty significantly, and traditionally does. Well, I won't say traditionally does, but this is showing what it's been over the last 12 months across the various markets. So over the last 12 markets, you can see in some places like Dallas and Fort Worth, South Florida, Houston, DC, that absorption has definitely been outpacing new supply. And that new supply too, also again, being impacted by what's going on in the availability of supplies and materials, the cost of labor and things like that. Let's see, mortgage debt outstanding. So when I mentioned Freddie Mac earlier, Freddie Mac is one of the GSEs. As you can see, those government-sponsored entities are responsible for lending 50% of the loans that are outstanding, the debt that is outstanding for multifamily purchases. Also, you have banks and thrifts, you have life insurance companies, state and local governments, CMBS, and then you have other multifamily mortgage maturities, just showing that on an annual basis, what the maturity amounts are, basically the amount of loans that are coming due on a yearly basis. As you can see, over the course of the next 4 or 5 years, we're going to have a record level, or at least in the highest in the last 10 to 15 years, level of mortgage maturities. So you're going to have a lot of activity in the multifamily market, either from a sale or refinance standpoint. Okay, and then this one is just showing what the monthly GSE lending value has been. Again, GSEs being Freddie Mac or Fannie Mae, and just showing how active they have been basically month to month over the last 2 years or so. All right, so big report, but we got through it. All right, so let's see. Let's touch on Marcus and Millichap. It's 2:37, so we'll definitely be done in an hour. I'm probably gonna try to finish this in the next 15 minutes or so. This Marcus and Millichap report, I actually don't want to cover the entire report. I just want to cover, let's see, there was a summary section. Let's see. Okay. All right, so let's just look at, yeah, we won't go dig too deep into the data. All right, I just want to look at the summary. Okay. All right, so let's look at just some quick bullet points on migration. Again, we talked about the Sun Belt metros doing well. The mountain region metros have significant demand momentum due to their fast growing populations and underlying dynamics. Quality of life and cost of living considerations are luring new residents. Demographic tailwinds, markets that fall in this category, those being Houston, Indianapolis, Riverside, San Bernardino. Some of these markets that fall in this category, they align closely with the strongest tailwind groupings in terms of demographic trends and locations, though in-migration and household formation have been slightly less impressive, keeping them a notch lower in the outlook. Okay, so this is just covering some of the I didn't want to cover this. We'll cover this. This is basically giving a breakdown of kind of what the markets, what kind of basically the cycle that they're in. But I want to look at a different report when we talk about the market cycle, because the market cycle, there's a better report that we can look at that gives a better visual on what the market cycles look like for each market. So let me just come back here to a couple points up here. The health crisis upends commercial real estate certainty, and that will carry into 2021. Pandemic transforms commercial real estate. Of course, we know that. Health crisis exacerbated the demographic shifts. We've been talking about that. Here's just a quick coronavirus case count map, and that's probably changed and shifted. This was definitely, this was actually, this is February 11th, 2021. Why is this even in here? Oh, no wonder. This is 2021's report. I was wondering, like, that doesn't look like the report that I had looked at before. So actually, let's skip over to Marcus and Millichap one. I pulled the wrong report. So we'll take a look at CBRE's report. Their report is actually really, really short when it comes to multifamily. So we'll just hit a couple points on this, and then we'll finish with the IR report. All right, let's see, industrial, multifamily. All right, so let's see, multifamily, record high demand and construction pipeline. The U.S. multifamily sector is poised to finish 2021 with overall occupancy and net effective rents above pre-pandemic levels. While certain markets face challenges, the overall health of the sector will lead to a record 2022. The growing economy is boosting household formation, which have been artificially suppressed by the pandemic. New households are catalyzing demand for rentals, which is expected to match the pace of new deliveries in 2022. Again, the data is going to be different. We forecast multifamily occupancy levels to remain above 95% for the foreseeable future, and nearly 7% growth in net effective rents next year. Construction will remain elevated in the near term. Completions in 2021 will likely reach a new high. Should say 2022. And another 300,000 plus units will be delivered in 2022. For context, deliveries averaged 206,000 units annually from 2010 and 170,000 per year since 1994, and they're expecting 300,000 in 2022. So about a 50% increase in what we've seen over the last 12 years, and then almost about 45% increase from what we've traditionally seen since 1994. All right, let's see. And then we'll just touch on from urban to suburban and back again. We talked about the shift from urban to suburban. Downtown multifamily properties are filling back up and occupancy rates are nearing pre-pandemic levels, spurred by a confluence of factors, fewer restrictions on urban amenities, higher vaccination rates, a growing willingness to use public transit, the reopening of college campuses, and more workers returning to the office. So we mentioned some of those things. Some of those top markets, though, still haven't recovered quite yet, like New York. We had mentioned New York and San Francisco. I believe it was San Bernardino and Midlands, Texas. Still looking for that pre-pandemic boost to get back to those pre-pandemic levels. And then just finish up with a summary. Investors still favor multifamily. We predict U.S. multifamily investment value will reach a record of nearly 213 billion. This is well above 2019. For 2022, we expect at least a 10% increase from 2021 to 234 billion. We talked about some of the expected growth in sales earlier from one of the other reports. And then FHFA is establishing a $78 billion cap on multifamily purchase volumes for Fannie Mae and Freddie Mac for 2022, which is up 11.4% from 2021. This level of liquidity should facilitate strong value growth. What's up? We're just going over some very extensive market data. If you're not in the multifamily space, you probably are going to be bored by all the numbers. But I had to actually re-record this because the first recording actually has some issues on the tech side. So anyway, we're finishing up. We got one more report we'll take a look at, and we'll be done in a few minutes. But this level of liquidity should facilitate strong value growth. In addition, we expect a resurgence in the flow of foreign capital targeting multifamily assets. Liquid multifamily debt capital markets, which includes traditional lending sources and alternative lenders like debt funds and mortgage REITs, will further stabilize and could even compress cap rates even as interest rates rise. We already talked about how compressed cap rates are. Now, in terms of foreign capital flowing in and being invested into the multifamily space, basically foreign capital investment basically died off in 2020 because investors couldn't get into the States for one reason or another with the pandemic. So now that travel has opened up a lot more, foreign investors are able to travel over to the States and make those partnerships or make those acquisitions that they need to invest their capital. So that's it. I'll finish with that CBRE report, and then let's just take a look at IRR's viewpoint and their market cycle information. They do a good job of basically telling you what cycle a market is in. Let's see, infrastructure. And they cover a lot of different aspects of the commercial real estate space. So here we are for multifamily. Again, showing top markets by multifamily transaction volume based on year over year percentage change. We have some of the markets that are considered in the bull market, top 10, Tallahassee, Florida, Fort Myers, Miami, South Florida, Fort Collins, Sarasota, Indianapolis, Jacksonville, Phoenix, Baltimore, and Reno. In terms of bear markets, your top 10 markets being Louisville, Albuquerque, Columbia, Las Vegas, Kansas City, Sacramento, Salt Lake City, Seattle, Greensboro, and San Fran Metro. Now, although those markets say the top 10, they still have had significant year over year growth, just not as significant as the bull markets. And the only market out of all of those 20, the only market that has saw a negative year over year growth was the San Francisco metro area. All of the other markets have seen mostly, for the most part, double and triple year over year transaction growth. So just looking at a overall map of that. All right, and then we'll finish here just the market cycle information, and I'll zoom in on that a little bit. In terms of just where we are, you basically have 4 different market cycles. You have expansion, hypersupply, recession, and recovery. During the expansion, you have decreasing vacancy rates, moderate to high new construction, you have high absorption, you have moderate high employment growth, and medium to high rental rate growth. For your hyper supply, you have increasing vacancy rates, moderate to high new construction, low to negative absorption, moderate to low employment growth, and medium to low rental rate growth. If the market is in recession, then we're seeing increasing vacancy rates, moderate to low new construction, low absorption, low to negative employment growth, and low to negative rental rate growth. And then for recovery, we're looking at decreasing vacancy rates, low new construction, moderate absorption, low moderate employment growth, and negative low rental rate growth. So let me zoom in on that so you can see a little bit better where the markets are. Some of the markets in the early stages of hyper supply, you got Cleveland, you got Denver, Syracuse, New York. In the middle of hyper supply, you got Birmingham, Alabama, Charleston, South Carolina, you got Philadelphia. Some of the markets in various stages of expansion, Atlanta, Austin, Baltimore, Boise, Charlotte, Chicago, Columbus, Ohio, Greensboro, North Carolina, Hartford, Connecticut. Some markets that are in recovery. You got Los Angeles, you got Portland, you got Columbia, South Carolina, you got New Jersey, you got Seattle. And then the only market, there's only one market that's actually listed in one of the phases of recession, and that is Oakland, California. So I'm glad I got through that. It was a lot, man. I'm telling you, it's much harder the second time. It was much easier to get through it the first time. But we had to get it done the second time. So here we are, we got it done. I'm just double checking everything to make sure we don't have any outstanding comments or questions. Looks like we are good. Check all my platforms. But yeah, that's it. So to summarize with what's going on in the market, we fully anticipate that 2022 is going to be another strong year in the multifamily space, both on the residential side and on the commercial side. There is a lot of capital that is already in the market, and a lot of capital that's going to continue to flood in the market from very big capital sources. And that's going to continue to put downward pressure on cap rates, which means that's going to put increased pressure on pricing. You have a couple of supply and demand issues that are going to continue to increase demand for rental housing, both single family rentals as well as multifamily rentals. So if you're having a challenging time finding good deals, that definitely, those are the reasons why. One of the ways that you can kind of get around having the difficulty in finding good deals is to shift markets. You don't have to invest in the top performing markets in order for you to still do well financially, in order for you to still be able to, accumulate cash flow, right? Appreciation is a bonus, but cash flow is really the ultimate goal. But that depends on what type of investor you are. So I would just challenge you to look at different markets outside of the ones that you're looking at. If you are having challenges looking for deals, I'm a part of a lot of different communities, and the market is very active. People are still finding deals. You just have to be on the lookout, and you may have to submit a lot of different market reports in order for you to find success in the marketplace. But with that being the case, I'll just finish with mentioning that if you are looking for an investor community, check out the Multifamily Investors Collective. We have a free community on Facebook, and we also have a premium paid membership community with more exclusive access to information, resources, and tools and things like that. If you want to check that out, go to the multifamilyinvestorscollective.com, and then I'll also put that information in the comments section. So I appreciate you for logging on and listening to this very, very, very extensive market outlook report for 2022. Unfortunately, the only way to get through the data is you got to go through the data, and investing at the commercial level is very, very, very data driven, numbers driven, a lot of numbers, a lot of data, a lot of things you got to be on top of to know what's going on, because all of these things impact and affect your investment. So if there's anything I can do for you, please do not hesitate to reach out to me. Send me a DM on whatever platform you're watching. I'm always checking in on a daily basis, my social media. So I will get back to you at some point, but let me know what I can do for you, and I'll be sure to connect with you and help you out as best I can. But that's it for today. I appreciate you all for logging on. All right, take care.